So in the final exam review sheet module, there's the review sheet. Click on it. It's going to open up into a PDF format. The Accounting 104 exam, like I said, is 66 questions, all multiple choice. And it's a full review on all 11 chapters. Now, if you think about it, we did 11 chapters. This was quite a lot of chapters to do, and I'm only asking 66 questions. So a couple of things. One, there's only going to be several questions from each chapter. Two, I'm not going to give you any questions on something that's quite minute. It's going to be the major
points
that are going to be emphasized that you should have picked up, you should have known by now. And three, the good news is the Accounting 104 final exam is going to be equal in weight to all your other exams. And so the last exam you took was 100 points. This test is 100 points. Okay, so that's what you should know about it. And again, like I said, it is a review. We spent the first half of the class on the first 4 chapters. So the final exam, the first half of the final exam, or about 33 questions roughly, is going to be on the first 4 chapters. We learned some of the most important things you're ever going to know in the first 4 chapters. I would say in chapter 1, it was those financial statements that we were introduced to. You learned about the income statement, the statement of retained earnings, the balance sheet. I would say the most important things that you need to know, even by now, is things like, revenue minus expenses equals net income. That's your income statement in a nutshell. Assets equals liabilities and stockholders' equity. That's your balance sheet in a nutshell. How they're all put together, you've worked very hard on doing way back when. There are no types of questions like that on the exam, but there may be some pieces of data, and they might ask you what the net income is. There might be some pieces of data, and you might be asked, what are the total assets here? So certainly understanding all those concepts are important. You got more detailed in chapter 2 when we looked at the classified balance sheet. Of course, all balance sheets are classified balance sheets because assets are looked at as either current assets or long-term assets. And in the long-term asset category, there's actually 3 to look at: long-term investments, property, plant, and equipment, and intangible assets. But the difference really is very similar to liabilities, where there are current and long-term. Current is less than a year. Long-term is after 1 year. So there are current assets and there are long-term assets, assets that are going to be used within a year or turned into cash within a year. Long-term assets are going to be used in the business for over 1 year. Current liabilities, debts that are going to be paid within a year. Long-term liabilities, the debts that need to be paid over 1 year. So that year period of time is really important to distinguish. You should, by this point, know a lot of the accounts, right? So if you're given a service revenue account, there's no doubt in your mind that's a revenue account. It's going to be on the income statement. Whereas if you were given an unearned service revenue account, you would recognize that as, oh, that's a liability account, because unearned service revenue means the customer paid me already and I owe the customer a service. That's a liability. So it belongs on the balance sheet. Not only that, it's a current liability. Right? So when we talk about the accounts on all the financial statements, you need to know where they all belong. That's assumed, and that's the most important part of the first couple of chapters. I will mention that in chapter 2, we did start learning a little bit about the ratio analysis that will become very prevalent clearly from chapters 5 through 11. but not a major part of what we started. So you know the statements, you know the accounts, you know where they belong. Now we can analyze transactions and find out whether they affected the financial status of the business. If they did, we need to do um, more analysis, right? And so we looked at all those transactions. We looked at the accounts that were affected by those transactions and whether they were affected in a way that we have more of it or less of it. So we have more cash or less cash, right? More sales or less sales, more debt or less debt. So all that analysis started chapter 3, extremely important all the way throughout. Then we looked at the account. Every account has two sides, just like every coin has two sides, right? Every account has a left side and a right side. The left side is the debit side. The right side is the credit side. And that's true for every single account, whether it's an asset account, a liability account, or revenue, or an expense account. All accounts have two sides. Only two things can happen in an account. You can either have more of something or less of something. And that's where you have to learn that for assets, the debit side represents more of the asset. So more cash, we would be debiting cash. But if the left side of an asset represented the more side, then the other side had to represent the less side. So when we have less cash, we would credit cash. Right? So you have to learn about that. But then when you looked at the other side and you looked at liabilities and stockholders' equity, you noticed that actually the credit side of a liability account is the side that we show more. So every time we have more accounts payable, we'll be crediting the accounts payable account because that's how we show more. Which also means when we pay down that debt, when we pay our bill down, we'll need to be debiting the accounts payable account to show we have less accounts payable. So again, all accounts have two sides. The names of the sides do not need to be confused with plus or minus. It's just debit and credit. For some accounts, debit means more. And for some other accounts, debit means less. For some accounts, credit means more. Other types of accounts, credit means less. That was the big thing to know about that. So once we did all that analysis and we looked at how the accounts were affected, we learned to use the journal. The journal is a very critically important concept in accounting because this is where accounting begins. Look at all the stuff we had to know before we could actually sit and do accounting, which starts in the journal. We had to know about all those accounts and how to analyze transactions and debit and credit and so forth before we can sit and actually do it. So there's a lot to it. But the journal is where everything starts. Anything that happens needs to be recorded in the journal. The journal is the very first stop. Okay. Once we have our records put into the journal, we then will transfer them or post them to the ledger. The ledger is a very large book, as you remember, that shows the history of what happened in each individual account. And so if you open up the ledger to the cash account, only things that happened in the cash account will be shown to you. Whether that happened over the last week, the last month, or the last year, that will be the record solely of what happened in cash. You move to another section of the ledger and you'll see what happened in accounts payable for that month or that year, because it's just the history of that. All that information in the ledger comes from the journal. That's how important the journal is. It's the source, it's the start of the information flow. Ledgers have all those accounts, and all those accounts have balances, which you need to know how to do. And to make sure the ledger is balanced, in other words, all the accounts that have debit balances and all the accounts that have credit balances are equal, we did a trial balance. And that's really all the trial balance was meant to do, is to make sure that now that we know all the accounts in the ledger and what their balances are, do the debit side balances equal the credit side balances? And that's basically it. So there was a lot going on in chapter 3, if you remember. And that's the beginning of the bookkeeping cycle. Chapter 4 closes the bookkeeping cycle. So remember, at the end of every accounting period, let's say a year, we have to keep records separate. We have to keep records separate from year to year to year. And so at the end of the year, we have to go through a process of closing our books, closing our accounting records for that period of time. So we can start brand new records for the next accounting period. Well, that closing process affects very specific accounts more than others. Revenue and expense accounts are really the most important ones that we focus on. So you learned a lot about adjusting entries. So the very first thing we do in the process to get ready to close our books is we start adjusting to make sure all of the all the revenues are there, all the expenses are there before we can say, okay, we are ready to close the record. So you went through that adjustment process. After you did the adjustment process, which again starts in the journal, those numbers went to their respective accounts in the ledger. So now we had to make sure that now that we did all these different entries through these adjustment process, that the ledger was balanced. And that's what we called an adjusted trial balance, and we did that. Once the adjusted trial balance is done and it works, those become our final numbers. Those are the numbers we use on those financial statements we learned about in way back from chapter 1. The income statement is always done first. Retained earnings statement is done second. Balance sheet is done last. And so we've done our statements. Now that we've done our statements, and that's our record for the year, we have to get ready for the very next day, which starts a new year, a new accounting year, a new record. And so we go through a process called closing, in which case we have to bring the balances in our revenue, expense, and dividend accounts to zero. And those were the closing entries. So this entire part, these first 4 chapters, took half the semester to get through because there was a lot to do and a lot of tedious work. This was very time-consuming, tedious work, but very, very important to know. Then in the second part of the semester, we switched gears. We looked more at specific areas, specific accounts, and learned more details about those accounts. Not only we learned more details about the accounts, we actually learned some analysis as well. And so chapter 5 and chapter 6 covered inventory. And it taught you for the first time about businesses that are dealing with merchandising, which are basically physical goods, physical products or goods. So understanding that businesses need, before you can walk into a Walmart and buy their goods, they got to buy those goods. So there was an invoice, and we looked at that invoice from the perspective of the buyer, and we looked at the exact same invoice from the perspective of the seller. And we learned a lot of interesting things. Okay. We then applied all those interesting things to the multi-step income statement. And this is one of the more important aspects here in chapter 5, because you learned first how to calculate sales. Now, sales doesn't seem that difficult, but look at the process we learned about. It starts with sales revenue. We subtract out returns and allowances. We subtract out any sales discounts. And sales really is net sales, net of those differences. So it started with net sales, and you need to know how to calculate that. Then it broke things down yet into further categories. One category was gross profit. That's the net sales minus the cost of goods sold. And the cost of goods sold is simply the cost of them buying their inventory. So we learned about gross profit, and we understand that that is a very important concept for the multi-step income statement. Then we subtracted all our other expenses that we ran business with to show our income from operations, or our profit from operating the business. That was also very important. From that, we learned about an other category, right? Other revenue and expenses, other other revenue and gains, other expenses and losses. That other category separates other activities that the company does that's not related to its core business. And that, after all of that, gave us net income. So, very important to know and review that multi step income statement and all the different parts to it, because that is a critically important component of it. We're going to talk a little bit more about the cost of goods sold with chapter 6, but we did end chapter 5 with some financial analysis, which were also very important. That gross profit rate, the gross profit compared to the net sales, very important everywhere. And the profit margin, that's the net income to the net sales, another extremely important ratio to understand. We then went into a little bit more detail into how do we come up with the cost of goods sold for inventory, right, on those records. How do we come up with the value of inventory? Well, companies have cost flow methods that they can choose from: FIFO, LIFO, and average cost. And those are the methods they use to calculate their cost of goods sold, but that also is how they calculate the value of their inventory. So you have to know, and you'll have at least one question on each, one LIFO, one FIFO, one average cost on the final. So you have to review that. They're basic questions. You should be able to calculate them without an issue, but you should review that and know all of that. We also know that once we put inventory on the balance sheet, inventory is an asset. We can never overemphasize and overstate the value of our assets. So we have to go through that lower of cost or market process to make sure that we're being conservative in valuing the inventory. So you have to know about that. And then, of course, there was some financial analysis on that inventory. Right? How quickly are we selling our inventory every year? That's the inventory turnover ratio. It does tell us how quickly we are selling out our inventory per year. Once we have that ratio, we can put that number under 365, and it actually calculates the number of days in which we basically have sold out our inventory. So, very important analysis. Chapter 5, chapter 6, mostly on inventory related stuff, but some very important concepts to review. And then we went on to the next module, had 7, 8, and 9. Now, chapter 7, we only did a portion of it. There's a little bit more to know on cash, but it's relatively simple to catch on. The most important parts we emphasized was this idea that cash is a very vulnerable asset. And one of the problems that that happens in business is when employees decide to take things from the employer without permission. Right? We call that fraud. And so there's a narrow definition that's applied here in Chapter 7. And that we also know that because corporations are trying to reduce fraud, Congress wanted them to put together more internal control systems. That's what the Sarbanes-Oxley Act required them to do. And so they had to do things like try to separate duties, segregation of duties, more documentation, human resource controls, things along that line that you've learned. So there are going to be a few questions certainly on fraud and those internal control principles that you've learned in that chapter. Chapter 8 was all about receivables. Most of it was on accounts receivable. Accounts receivable is an asset account, and it's the amount of money we're waiting to receive for work we've already done. Right? So we've already done the work, or we've already provided the goods. We're waiting to receive payment. So eventually, as you know, accounts receivable will be cash. Accounts receivable as an asset will be put on the balance sheet, and thus it needs to be valued properly. Just because you're owed money doesn't mean you're going to be collecting all of it. And we know that. And so we can't say $1 million worth of accounts receivable is worth $1 million on the balance sheet. We have to be conservative, right? We have to make sure we are doing things properly according to GAAP. So we have to use something called the allowance method. And you learned about the allowance method and that objective, showing us that we have to estimate how much of our receivables may end up as bad debt. And that's the allowance method. We also created an allowance for doubtful accounts, which is a real account. It's a contra asset account. And it shows how much the company is expecting um, their not to collect from their accounts receivable. So that was very important to know how to do, and that will be certainly on the test. We also looked at notes receivable, calculation of interest. Now, with a notes receivable, you made a loan for a period of time. Most notes receivable are current assets. They're going to be collected within a year. But let's say it was a 4-month note receivable. You know what's going to happen in 4 months. You're going to be receiving back the entire loan, the entire note, plus the interest all at one time. And so we looked at that in more detail, and that's something you will see on the final couple of questions there. Um, we also again looked at how the balance sheet records their receivables. Notice that allowance for doubtful accounts is often listed, or they'll put the net of allowance down to show that they did make an allowance for uncollectible debt. And then some ratios on receivables. We looked at the accounts receivable turnover ratio. Now, your ratio should match your period of time. Most times, businesses want to collect their receivables every 30 days. So, since there's about 30 days in every month, they should be collecting receivables 12 times a year. So, we did an accounts receivable ratio to see how companies were doing. Again, they should be collecting about 12 times a year if they're expecting to get paid every 30 days. Once we know what that ratio is, we put that underneath 365. It actually gives us a time period, how quickly or how slowly they're collecting their receivables. Okay. Chapter 9 was all about fixed asset, property, plant, and equipment, as well as intangibles. The first thing we learned to do, which was very important that you need to keep in mind, is how to calculate the cost of a plant asset. So when a company buys a piece of land or when they buy a building and they have all this money they have to spend for it, what of that is part of the cost of that asset? So we looked at everything that they need to spend to get it ready for use. The standard is ready for use. So we learned about that, and you had some calculations to do, and you'll see a few more on the final. All those plant assets are going to be used for a long period of time. They're property, plant, and equipment because they're long-term assets. It means all of them expect to have a use of over 1 year. And in some cases, 10, 20, 30, 40 years in some cases, depending on their buildings, machinery, equipment, other types of things. They can last a long time. Because they're using it for business purposes and they know that those assets are going to need to be replaced. Equipment doesn't last forever. Computer equipment doesn't last forever. We talked about parking lots and fences. They don't last forever. They're going to have a useful life. At the end of that useful life, they're going to need to be replaced. However, those useful lives can be very long, like I said, well over a year, 5, 10, 15, 20, 30 years. And the process of allocating the cost of using that is called depreciation. So you need to know what depreciation is. We focused on specifically straight line depreciation of how companies, and over 80% of them use it, how companies go ahead and calculate the depreciation on their assets to expense. We also looked at what happens when they actually dispose of their plant assets. So they have an old truck, right? They have a few choices. They can sell it. They can junk it. They can be worthless. Either way, we're going to look at how much money they get from either selling it to a third party or junking it at the junkyard. And we're going to compare it with the book value. So The money they receive is the proceeds. We compare the proceeds to the book value. Proceeds are more than the book value, they have to record it as a gain on the disposal of plant assets. If the book value is more than the proceeds, they have to record a loss. Remember, those gains and losses are on the multi-step income statement from Chapter 5. But that was important, the use of the book value to determine whether it's a gain or a loss. That's important. We also looked at some very interesting aspects of intangible assets. You basically need to know the differences, more definitions, the differences between, a patent and a copyright and a trademark and goodwill. It's more definition based, right? So that's something that's going to be on here. We also looked at some analysis. The return on assets was one of them. Asset turnover ratio was another. So, are we using our assets to generate sales? I think that was asset turnover. And then are we using our assets to generate profit, the return on assets? So basically those financial analyses were really important in that chapter. And then we just finished module 6, which was chapter 10 and 11. Again, important things to understand were concepts. Emphasis is on concepts and definitions here. Part of the most important things you could have learned in chapter 10, objective 1, is just how many more current liabilities there are than you might have thought. Specifically, the tax issue, sales tax payable, very important. And then all the payroll taxes, right? The FICA tax, they take money out of your checks to pay the appropriate government agency you owe the money to, whether it's the federal government or the state government. But that is money that is a liability on the books of the company from payroll, either from sales tax if they sell something that's taxable, and payroll, or just payroll. But either way, they're big current liabilities. Actually, another current liability that came from Chapter 11 is the dividends payable. That's also a current liability that you learned about. We also learned in Chapter 10 about bonds payable. Bonds are long-term loans from investors, so they will be long-term debt, long-term liabilities, bonds payable. And we also looked at a few ways in which liabilities are analyzed, such as that debt to equity ratio, times interest earned, very, very important type of issues were analyzed as well. Chapter 11, some advantages and disadvantages of corporations. And again, I can't emphasize enough that you understand not just simply common and preferred stock and their rights, but the difference between authorized shares, issued shares, outstanding shares, and treasury shares or treasury stock. Very important that you are able to piece all of that together. You'll see that over and over again. The most common dividend is a cash dividend. So we looked at declaration date, record date, and pay date. And then we looked at a little bit of analysis for common stockholders, payout ratio, and return on common stock equity. From that, you should see, and I'm on the Wiley site now. Way down here, you'll see two things. The final exam, the final review is just an exam. It's ungraded. You can take it over and over and over again if you want. But you see here the Accounting 104 final exam timed. It's a 3-hour time limit. You have 66 questions in 3 hours. Plenty of time. The questions are arranged in the order of the chapters that we did. So it's sort of meant to be that type of review. I'm not trying to be very straightforward. And did you pick up the major points that we went over? And that's basically what your final exam is going to be on and what it's going to be like.